Now, Singapore could see higher interest rates. This after the U.S. Federal Reserve made its biggest rate hike in 22 years. The Fed raised it by half a percentage point to fight soaring inflation. And this move could also impact Singapore's economy. Now, Singapore Central Bank does not set interest rates directly. Domestic interest rates are largely influenced by global market movements. And the COVID-19 pandemic put Singapore, like the U.S., into a lower interest rate environment. This was meant to spur economic growth and cushion fallout from the pandemic. But consumer prices were soaring with global supply chain bottlenecks and the war in Ukraine. So to tame inflation, Singapore took steps to tighten its monetary policy with its latest move last month. It effectively strengthened the Singapore dollar. The latest U.S. rate hike will likely cause local interest rates to jump as well. And to tell us what the U.S. rate hike would mean for Singapore, we are joined by Steve Cochrane. He is Chief APAC Economist at Moody's Analytics. Well, Mr. Cochrane, how will this U.S. rate hike impact Singapore, remembering that already Singapore tightened its own monetary policy recently?
That's right. In fact, that's a key factor here in that the monetary authority of Singapore has already begun this very same process of tightening monetary policy to try to control inflation, which has bounced up pretty quickly in Singapore over the last 2 months. So because the MAS is moving, in a sense, on a similar path as the Federal Reserve, it means a little bit less interruption or a little bit less of a surprise for Singapore. Somewhat different if we can compare it, say, to India. In India, the Reserve Bank of India did a surprise rate hike today in the wake of the increase at the Federal Reserve. They had been waiting a long time because the economy of India is somewhat weak and they wanted to make sure that it could stand on both legs, so to speak. And so they had to do a surprise hike. MAS is already on its way. So the process is smoother here and smoother in some of the countries around Asia Pacific where the central banks already have begun this so-called normalization process.
Now, borrowers are set to shoulder a greater burden to service their existing debt. And this is especially for homeowners with floating loans. Such loans come with interest rates that are subject to periodic adjustments as compared to fixed loans. And this means borrowers will fork out more money to repay their mortgages when the interest rates go up. So, Mr. Cochrane, as households pay more for existing loans, how will savings, spending and investing decisions be affected then?
Yeah, if a household has a floating rate mortgage, then their monthly payments will begin to rise as interest rates adjust. That does take away from available cash that can be spent on other items. And it also then works to slow the housing market down. If purchasers are looking to find a mortgage, the mortgage rate is going to be a little bit higher as well. All this, in a sense, works to tamp down inflation because it does in a sense, ease demand for many goods and services. I think the positive factor for the Singapore economy is that there is right now a fair amount of pent-up demand, particularly for services, as the economy has come out of the all the social distancing measures. The restrictions on working at the workplace are gone. All offices can be occupied at 100% capacity. People are out in the evenings spending money and so forth. And so there is a bit of an offset from the higher rates for either durable goods or mortgages by the pent-up demand that there is for services and for goods that don't require any kind of credit.
Now, households aren't the only ones affected. On the business front, firms facing a higher cost of borrowing could similarly have more difficulty servicing their loans. And this could reduce profit margins and increase the required return on new investment projects. The impact, though, may vary across industries. So, Mr. Cochrane, with the impact varying across sectors, do you foresee a negative impact on demand, especially in sectors like F&B and tourism? And if so, what would this mean for their post-COVID recovery?
So it will vary by sector. You mentioned F&B and you mentioned tourism. And again, actually, these are sectors that are going to, I think, face fairly strong demand for services over the coming months, again, because of the opening up of the limiting of the end of social distancing measures and the opening up of international travel. And so I think demand will be good, and so there probably will be less of a holdback in terms of small SMEs trying to find credit to open small businesses to serve in the F&B industry or somewhere in the hospitality and tourism industry. Other industries, it might be a little tougher because there isn't this surge of demand right now, and it may be a little more difficult to put together a business plan that's going to immediately generate returns. Might be a little more difficult to qualify for a loan. The risks may be a bit higher, or you may have to pay a little bit of a higher rate.
Yeah, so one sector that's likely to see an impact from rising interest rates is construction. Now, construction firms could potentially be hit as they tend to depend more on commercial bank loans. Well, Mr. Cochrane, given that high interest rates disincentivize borrowing, what does this spell for businesses, especially those SMEs who need to borrow cash to grow?
Yeah, SMEs always have probably the hardest time in terms of borrowing, because it's more difficult to simply provide the financial information quite often that's required to get a loan. And then if interest rates are rising and the scrutiny is that much tougher on loan applications, it can be tough. A couple of advantages for Singapore, just that many SMEs in Singapore are probably in a little better financial condition than in other countries around the region, because the government's very supportive fiscal policy over the last 2 years during COVID has helped SMEs to help manage their books. They should be in a little bit better shape than in many other places around the region, and might help them to be able to get the credit that they may need. And also the government has been very supportive in helping businesses to put together expansion plans and so forth, and that should help as well. But SMEs always, traditionally have a little bit harder time getting credit than do more established, larger companies.
Well, many thanks for that, Steve Cochrane there. He is the chief APAC economist at Moody's Analytics.